Are you strongly bearish in the market? When it comes to trading options, there are actually several strategies that you can use to make money, even when the market's going down. And here we're going to look at a few strategies, probably the key strategies that you should really consider when you're bearish. The first one is just buying puts. And whether you're a seasoned options trader or you're just starting out, sometimes these are a perfect strategy. Simply, you just have the right, but not the obligation, to sell 100 shares at a specific price within a specified time frame. And when they should be used really depends on what kind of market's being traded. It really works best when you expect the price to go down pretty quickly. So imagine that you buy a put option for ABC stock. Strike price is $50 for $1.30. So this means that you have the right, but you are not obligated to sell 100 shares of ABC stock at $50 per share by a certain time. So to have this right, you pay a premium of $1.30 per share times 100. So $130 to the seller of the option, and they must buy the ABC stock from you at $50 a share if you decide to sell it by exercising the option. So if the ABC stock drops down to $40, you could exercise your option, sell the stock at $50 per share, and then buy it immediately at the current market price of $40 per share. And this would give you a profit of $10. The fact is that less than 10% of all contracts are exercised. So if ABC stock goes up to $60, you would not exercise your option because you could sell the stock at a higher price than the strike price. So the contract's worthless. So the most that you could lose on this trade as the buyer of the option is what you paid, which is $130. So the main advantage of using individual puts is they allow you to benefit from quick downward movement. You don't have to short sell stocks. And that comes with its own risks and implications. And it is an expensive way to short, but they do offer some pretty good profit potential. They're essentially unlimited when you're buying the calls, actually. Then your risk is limited to what you paid to put a trade on, so you know how much you're going to lose. Time decay. That is the biggest enemy of buying puts because the longer it takes that stock to move, the more you lose on the contract. The second one is a long put vertical spread. And all this is you purchase one out of the money put option and you sell another out of the money put option. So this means that the strike price of the sold option is lower than the purchased one. And this helps you limit losses because it reduces the net debit that you take on when you enter the trade. And your maximum loss, that's restricted by how much further out of the money your short strike is compared to your long one. And this strategy is great for traders who anticipate trading for an extended period. They want to reduce their initial cost. And it's also great for those who want to benefit from small price movements in either direction. And if there's not much movement in either direction, then both legs will likely end up near expiration value, resulting in minimal losses or gains. And finally, you can use this when volatility is low, as it reduces risk by limiting potential losses, or when volatility is high because it allows you to benefit from potentially large profits with limited capital. So a more detailed look. So ABC stock is trading at $40. We buy one put option at a $40 strike price for $3. At the same time, we sell one put option at a $35 strike for $1. So what does this mean? This means that we have the right to sell 100 shares of ABC stock at $40. We have an obligation to buy 100 shares if the buyer of this contract exercises their right at $35. Now, unlike buying a put, our profit potential is limited, and it's limited to the difference between the short and the long strike, which is $5 in this case, minus the cost of the trade, which is $2, or $3 is your maximum profit per share, $300 per contract. At the same time, our risk is totally defined to what we paid, in this case, $2. Now, we also can't forget that we did receive a credit when we set up this trade. So these tend to be cheaper than just dealing with puts. Now, utilizing a long put vertical spread comes with advantages for traders who are looking for ways to reduce their initial cost and still being able to capitalize on potentially significant market movements. And while this strategy, it does require some knowledge and some understanding of options trading and risk management, it can also provide you with an excellent way to control your exposure levels and still being able to profit from market volatility. The short call spread. So if the implied volatility, the IV, is above 50, then it might make sense to sell a call spread. A short call spread, again, it's a bearish strategy. It involves two calls, same expiration date, different strike prices. So first, what's implied volatility? That's just a measure of how much traders, investors, they expect an underlying stock to fluctuate over a certain period. And it's determined by analyzing the current price of contracts on that particular stock. So the higher the IV, the more expensive contracts are, which means that traders are expecting greater volatility in the stock's price. So the goal of this strategy is to profit from an expected increase in the volatility, or at least not go lower, or for the underlying asset to remain below the higher strike price at expiration. So this involves selling an out-of-the-money call option and buying an out-of-the-money call option with a higher strike price. So by doing this, you can take advantage of an increase in implied volatility and potentially benefit from any downward movement in the stock. So an example, let's pretend XYZ is trading at 37 bucks and you're bearish. To set this trade up, it would look something like this. You'd sell one 40 call for $4. You would buy one 45 call for $1. You are obligated to sell 100 shares at 40 bucks if that contract is exercised. But you also have the right to buy 100 shares at $45 if you choose to exercise it. So because you sold a call, that premium is a credit. So in this case, you net $3 after paying for the call that you bought. So your profit is capped at what you keep as the credit for the trade, which is $3 or $300 a contract. The most you can lose is the difference between the strike prices minus the credit received from selling the spread. So a $45 strike minus a 40 strike is $5. You receive $3 credit, so $2. It's your maximum loss per share. So the main pro of using short call spreads is they're relatively low dollar risk trades. They offer a decent reward if you do them correctly. And yeah, your profit potential is limited. These are less expensive trades to set up. You can profit from two different market movements. As long as we stay below or right at the short strike price, we're going to make some money. But there's some cons. If volatility decreases or there's not enough downward movement in the stock prices, then your position's not going to benefit as much. And also, if there's sudden changes in market conditions, then your position could be at risk as well. So again, make sure you do your research, make sure you know what you're getting yourself into. Now, no matter what kind of trader you are, bearish or bullish, there are always some strategies out there that can help you make money, even when markets are not performing as you expected them to. And whether it's individual puts, whether it's short call spreads, long put vertical spreads, short call vertical spreads, there's a whole bunch. There's something for everyone out there and every market condition. The key is just do your research, know what you're doing, understand all the risks. And if you're looking to get started in the markets or just something a little bit different, we have a thing called Dynamic Duo. You can download this guide. It has all the information that you need to trade two highly successful markets and potentially see some pretty serious profits. We also have a one-day strategy inside of that free PDF guide as well. You can download again. Totally free. The link is to the left or down below this video. All right. Thanks for watching. Talk to you soon.